Hey, what's going on, guys? My name is Alex, and today I would like to talk to you guys about debt's effect on your returns in real estate. So, what effect does getting a loan have? Should you buy properties cash? Should you get a loan? That sort of thing. So, without further ado, let's get into it. So, debt and returns in real estate. So, the proof promise plan of this video here, proof, why listen to me at all? You don't have to, but I've got 12 of my own rental units. I've been a part of hundreds of different real estate transactions through the various companies I've owned or worked for, or my own portfolio. Analyzed thousands of deals. The promise is you will understand by the end of this video how debt affects returns, specifically in real estate. And the plan is, one, we're going to go over how returns are actually calculated. Two is other advantages of leverage. Leverage is kind of another word for debt in real estate. And we're going to play it out with an example. We're going to kind of play with the numbers a little bit to hopefully give you some clarity there. So, starting off with how debt is actually calculated. And I'm going to move that up there so you can see. Okay, so looking at how do we calculate ROI exactly? Make that really small. ROI is essentially our net return on investment, the all the benefits we get, divided by how much capital it took to get that investment, right? So your net return on investment, that's going to be things like your cash flow plus the equity growth plus the tax benefits that you're going to get, right? So like let's say if you pay 10 grand less in taxes this year because you did this investment, like that's 10 grand net positive to you. So we're going to include that in your ROI. So basically all the benefits of the investment, divide that by the amount of capital that you have invested in the deal. So maybe this is literally just purchase price. Maybe if it needs some work, maybe it's the purchase price plus the renovation budget. Essentially the money it takes for you to buy the deal, get it up and running, get it up to speed and get it performing. And then we're just going to times that by 100 to make it into a percentage. So really it's just the money you get, divide that by the money you put in. And typically it's calculated on a yearly basis too. So let's look at example 1 here. So in the first year, between the cash flow, the appreciation, the tax benefits, XYZ, let's say we got 10 grand from that investment. So cool, awesome. I got 10 grand and I bought the property for $100,000 cash. So essentially our ROI is 10,000 divided by 100,000 times 100 to get it into a percentage, which is a 10% ROI, 10% return on investment. Cool. Very good. 10%. Love it. Now to kind of play with this, let's look at example number 2. And this is how debt affects your ROI. So let's say you get the same $10,000 from that investment, but this time, instead of just buying the property for $100,000 cash, instead this time we got a loan for $80,000 and we put down $20,000 for a down payment. So the money that we have in the deal, the money it took for us to buy the deal, it's not $100,000 anymore. Now it's only $20,000. So that is going to crank up our ROI. So that's now we got a 50% ROI. So really, by getting debt or getting leverage, what we're doing is we are decreasing the denominator in this equation, right? So we're using less of our own money to get this investment. So the returns are going to be, for the most part, the same, but the amount of money it takes us to acquire that and get those returns, that's going to go down when we use debt. So that's the thing we're playing with here. That's the advantage. So here's some kind of other advantages too, and other ways of looking at it, and other ways that you're going to get more benefits of using debt. So for example, let's say you bought that $100,000 property and we're looking at 5% per year appreciation. So every single year, roughly, the value of the property increases by about 5%. Okay, awesome. So from just appreciation, you bought the property for $100,000. Next year it's worth 105. So with just the appreciation, you got a 5% return there. Awesome. Super good. Now, if we look at this from kind of like an extreme example, let's say instead of buying the property for $100,000, let's say we did like an owner occupied loan, 3% down, just to make this an extreme example. So this is the money that we have in the deal, and this is all debt. And we get the same exact 5% appreciation. So now when we move on, look at the next year, we only put in $3,000, but we got $5,000 worth of appreciation. So that's greater than 100% return on our money just from the appreciation. It went from literally just 5% to over 100% appreciation. So that is the power here, right? So there's lots of ways that debt can benefit you, but this is a huge one. Is you're controlling a very large or very valuable piece of real estate with a very small amount of money, and you get all the benefits of controlling that piece of real estate. One of the major benefits is the appreciation. That asset is going up in value over time, and you get the gains on the entire value of the asset, not just the money that you have invested. So that's really cool. Awesome. So debt also is going to really help us get a higher return on our equity. So looking at this from kind of two different options, both options we're going to have $100,000 in equity. Option number one, though, we just buy one property for $100,000 cash, and that's great. We've got $100,000 in equity. Or we got option two, where instead of buying one property, we buy five, and we just put 20% down on each of them. Still $100,000 in equity, but you can probably see where this is going. Option two is going to get us a much, much higher return on our equity. So looking at example one here, we're going to just put some numbers to it. So we bought the property for $100,000 cash. Income, let's say, is $10,000 per year. Operating expenses are 50%, just to make numbers easy. So we got $5,000 in cash flow, $5,000 in yearly appreciation, and let's say the tax benefits for year one are $5,000 too. So just trying to make everything easy. So our net from that investment in year one is $15,000. We're going to divide that by the amount of money that we had to put into it, and then we're going to times it by 100 just to make it a percentage, and that is going to get us a 15% ROI. So that's pretty cool. That's pretty good. Most people would be very happy with a 15% ROI. Now, looking at example two. So in example two, we took that same $100,000 and we bought 5 properties by putting 20% down on each of them. The cash flow per property is definitely going to be less because now we have to pay a loan on each property, right? So it's definitely going to decrease our cash flow. But we still get the tax benefits of owning the other pieces of real estate, and we still get the appreciation and other benefits, right? So let's take a look at this. So this is just comparing, the cash flow if we just bought one property, the appreciation if we bought one property, and the tax benefits if we just bought one property. Compare that to, okay, let's say the cash flow if we did buy 5 properties, let's say it's still about the same, still got about $5,000 cash flow. But the appreciation, now we're controlling $500,000 of real estate instead of $100,000 of real estate. So we get that 5% gain on each property. So that's huge. And then same with the tax benefits. We got the tax benefits of buying 5 different properties, right? So instead of that, instead of making $15,000 in that first year, we made $55,000. And that is going to get us a 55% return on investment in year one. So that is crazy. And that is the power of debt and why this is so powerful and why everybody, not everybody, but most people do choose to use it. So disclaimer, there are reasons to not use debt too. For example, the more debt you have, most of the time, the more risk you have as well. So it's not like it's all sunshine and rainbows, and not like debt is just perfect and in every situation we should just get more debt. But it is an extremely powerful tool, and people shy away from it a little bit. Maybe rightfully so, maybe not. But I want everyone to kind of understand, here is the benefits of it. Here is why I wouldn't buy a property cash for $100,000 at this stage in my life. Maybe if I'm retired and I just want to decrease risk and decrease headache, sure, it might make sense then. But right now in growth mode, I do want to leverage debt, and I want to share these ideas with you so you guys can make the appropriate decision, um, based on where you're at in life too. So are you in a stage where you want to you want to use debt, you want to expand your portfolio, you want to grow, you want to compound, or are you in a stage of life where you want to reduce risk, you don't want to have to get rich twice? So you already amassed the wealth you want, now you're just trying to decrease risk, increase cash flow, less tenants, that sort of thing. That makes sense too, and I get that. But again, it just depends on where you're at in your journey and what your goals are. So let me move this back down here. That is essentially how debt affects your investments in real estate. And the core principle there is that with the same amount of money from you, you get to control more real estate. And controlling more real estate means, it's got a lot of advantages, but it means more appreciation, principal pay down, tax benefits, all the benefits, right? So it allows you to control more real estate with the same amount of money. And that's kind of the key thing here. So if you guys would like to invest together, this is something I do. I love partnering with people. I bring something to the table that you don't have, and you bring something to the table that I don't have. 1+1 = 3, right? So it's super powerful. I've been rewarded every time I do it. So I want to do it more. I want to help people. I want people to help me, and I want to do this together. So there's my phone number up on the screen. There's my email. Shoot me an email. Also, if you want to invest together, I'm going to drop a Calendly link in the description here so you can book a meeting. We can hop on Zoom and see if we like each other. So, so yeah, I look forward to hearing from you guys. Drop a comment, what you learned, what you want to see next, and I'll see you on the next one.